What's up, owner investor? In this video, we are going to talk about how businesses can defend themselves against competition and how, as an investor, we're going to evaluate a company's ability to do that. Unfortunately, this is going to be the most complex, but also the most important section because competition is just kind of a reality of all businesses, whether they're private, small businesses, or Fortune 500 publicly traded stocks. This is also going to be the area where there's the biggest difference between investors with little to no experience, with even like with 10 years of experience like myself, and investors like Warren Buffett with many decades of experience, right? So this is the area where that experience and looking at hundreds, if not thousands, of companies and following them for many years will and having high quality frameworks that are refined over time. This is when all of that will be seen in the skill set of an investor. It'll take years to like fully absorb this stuff, so I would just be really patient with yourself. And recognize that this is just going to be kind of a process because it's very qualitative, it's subjective. Smart investors can disagree on the quality of a company's competitive advantage, and so it's something to kind of just keep an open mind about. And it's always just going to be a working hypothesis where you're looking for new confirming or disconfirming evidence of whether this company that you're looking at is going to be around and thriving in the next 5 to 10 years. Um, so again, this is not financial advice because a lot of stuff in here is going to be subjective. My goal is to really get you to the point where you can copy great investors and where you can read the Berkshire Hathaway shareholder letters and actually get a lot out of reading that and really understand what Buffett is trying to say and kind of link that up to like a lattice work of mental models and frameworks so that you can kind of see the bigger picture of how to actually pick stocks to invest in for the long term. Um, like I said, the idea of competition is central to business, right? As Mark Cuban says, competition, business is the ultimate sport. Let me just pull up this quote instead of misquoting him. Mark Cuban competition quote. Yeah, there's no one more competitive than me. Business. Yeah, it was something like it was a little bit more detailed than this. It was something like, you know, business is the ultimate sport. It's 24 hours a day, 7 days a week, 365 days a year, right? Because there's always someone that's trying to steal your customers, or yeah, like offer a better service, and just erode away any like profits that you're trying to make, right? That competition might not show up immediately, but it's always you should always, even if you're a private business owner, or if you're looking at stocks, like you should always be thinking about whether someone else can serve your customers a better offer and can consistently do that. So it's a really important idea. Another kind of reason to explain why, to really drive home the point of the importance of this, is you can look at the S&P 500 today versus 50 years ago. Um, years ago. Okay, I'm not trying to calculate the returns. S&P 500 companies. I'm just trying to show you how different the S&P 500 was uh, today versus you know 50 years ago. Okay, yeah, this is a really nice graphic. Okay, so as you're watching this play out, right? It started off with with mostly industrial companies, and now you can kind of see that the number of industrial companies going down, and then all the kind of like consumer discretionary and like information technology companies going up, right? And that goes back all the way to 1969. So even if 500 of the biggest publicly traded companies, even they don't remain competitive forever, right? Like you can think about it like this: the longest lasting institutions in the history of mankind is our religions, and then it's I would say like empires or countries or nations, right? And even then, like countries don't last forever, right? Like it's an anomaly when you look in the context of history for countries to last more than like a few hundred years. Um, Ray Dalio makes this argument in his newest book called "Changing World Order." Um, and then after countries, you can think about cities, and then after cities, I would say businesses are kind of the next category that I can think of, where a business lasting more than 50 years it's very unlikely, right? So like let's look up the failure rate of startups in US, right? So approximately 10% of startups will fail within the first year, according to bureaus. Long runs, yeah, over the long run, 90% of startups fail, right? So like business is a like statistically like risky endeavor, right? So when we're selecting stocks, we should take that into account, right? So whenever someone pitches you some like, sketchy biotech stock, with like less than $100 million in market cap, come back to the statistic that 90% of startups fail, right? And and realize that there's a reason why it's safer to invest in more established larger companies. But even in that, even with these larger companies, right, you can see the history of the S&P 500, right? So it's really, really important to focus on competition. But I would say broad. Geez, I'm having a really hard time getting this word out. But even from a more broad perspective, asking yourself, is there someone else that can solve this customer base's problems, and offer them more value for a lower price than whatever company you're looking at, right? This is kind of the most central, the most important question you can ask when it comes to analyzing business models. Um, so now that I've kind of beaten that dead horse of just saying how important it is to think about competition, let's take a step back and kind of just think about what a business is broadly, right? Like the way I think about a business is almost a money AT like a money ATM machine where you put in money into the business and then ideally, we call that capital, right? That you invest into the business, and ideally that turns into more capital over time, right? But there's uncertainty, unlike an ATM. You put in, a dollar into an ATM and you get like, a bottle of Coca-Cola or something. But with a business, you put in money into the business, capital, and you get cash flows over time. And there's uncertainty on, kind of when those cash flows will come and like the size of those cash flows, right? But that relationship between how much money goes into the business and how much cash flows the business generates, that is like the key thing to look at, right? And we refer to that as return on capital, and there's lots of different ways to measure it, but um, kind of the central one that we're going to focus on is called return on invested capital. And you can look this up, and I wouldn't get married to like one definition. There's like kind of modified definitions of this, and so uh, basically the numerator is like some measure of profitability um, before the company makes interest payments, right? So in this case, they're using NOPAT, which stands for net operating profit after tax. Um, so let's see, just to kind of tie this all together, pull up this Airbnb thing that we created in a previous module, right? Okay, so this is the operating profit, right? So if you just take this and let's just assume the tax rate is like 25% for Airbnb. Oh yeah, it is 25%. Okay. So in this case, because Airbnb doesn't have any debt, your net income is going to be kind of the same as the net income that we calculated here is going to be the same as the net operating profit after tax they're using in this definition. right? So 1.35 billion dollars of net operating profit. Um, and then average invested capital. I mean, we don't have to use average. Let's just we can look up Airbnb right now. Airbnb. Okay, so why don't we'll use the fiscal 22 number since that's where the numerator came from. Okay, financial statements schedules. There you go, financial statements and supplementary data. Okay, so for the invested capital, we need to go to the balance sheet. Um, okay, so let's see how these guys define it on this website. Oh, I guess I use that same tab. Okay. So invested capital, fixed assets plus net working capital. Um, okay, yeah, you can use that definition. Um, okay, so fixed assets would basically be, it's property, plant, equipment. Um, property, plant, equipment. I'm going to exclude goodwill. This is basically, again, this is going to be like kind of a niche, like accounting concept. When a company acquires another company and they pay more than like the accounting book value of equity, um, they have to create this thing called goodwill. It's basically a plug variable, so it's not really something that's going to matter for us in terms of determining how efficient is Airbnb at taking money that's put into the business and turning that into cash flows. So, so we're going to ignore this and intangible assets, and we're going to just focus on property, plant, and equipment, of which there's 157. Oh, this is a percentage here. Okay. Italicize this. 157. All right. Other assets, non-current, 188. Okay, now we look at working capital. So working capital, some people again will define this as current assets minus current liabilities. We want to exclude the cash and marketable securities because that's not really capital that's being used to run the business, right? So we're just going to use this 3715 number, 3715 plus 349 minus accounts payable minus 118 minus 118 minus, we're going to ignore the 63, accrued expenses minus 1559 minus 3715 minus 375 minus 904. Okay, so admittedly, I have picked a kind of a confusing example to demonstrate this concept. So for that, I apologize. Most companies will have positive working capital, but Airbnb has negative working capital. Um, in some cases, this can mean the company is in financial trouble and is going out of business, but in other cases, it means that the suppliers or the customers of the business actually finance the operations of the business, um, which is what's happening here because Airbnb is not absolutely not in any financial trouble. So fixed net fixed assets, working capital invested capital. So let's just double check with ticker.com, see what they think in terms of A, B, and B. Interesting. So they're using a different definition. Yeah, because they're going to be including the cash probably. That's why. Um, yeah, that's why. Okay. So the invested capital for Airbnb is negative $1.9 billion. And so it's going to seem like, so this is like the beauty of Airbnb. Like, let's just calculate this for some for like a railroad company. Okay, so CSX, Canadian Pacific Railway. So I don't want to go through and like calculate this whole thing, but for Canadian Pacific Railway, it's about 16% return on capital. Just want to make sure they don't have like a ton of. Okay, so they also have a lot of cash. Yeah, but you can see that there's $35 billion of property, plant, and equipment. The actual like the tracks and like the box cars and the actual trains. Um, and you can see like they're not going to have enough negative working capital to they have like yes they also have negative working capital. The negative working capital is not going to be able to offset all this property plant equipment, right? So they have around $30+ billion of capital that's invested into the business, and they generate before taxes around $6 billion, right? So $30 billion of invested capital, and there's $6 billion that gets generated against that, right? Versus Airbnb, it's negative invested capital because their suppliers and their customers pay them in advance um, before they actually earn the revenue from the sales from people staying, right? Like you pay for your Airbnb before you go um, stay there, right? And there's a certain amount of days that Airbnb holds on to the money before paying the suppliers, and it's not really a capital intensive business. They don't have like freight trains running around. They don't have like millions of miles of railroad tracks, right? So it's a very very efficient business, right? This is like the holy grail in in running a business where the business doesn't require any incremental capital to run, where it's financed by your customers and your suppliers, and it generates over $1 billion of profits. Right, that's pretty incredible. That's a very efficient business. Now, because Airbnb is such a like efficient business, it's such a good. It would be like walking up to a slot machine that like you just walk up to it and it just started like paying out all these uh, all this money to you, right? In a way that's kind of what Airbnb is, um, which is why it trades at the valuation that it trades at, right? So business is just a money ATM, right? And calculating this return on invested capital is how we put a number to how efficient the business is taking capital and converting that into profits. Now, when you find a business that is very efficient at doing this, like Airbnb, the question is, can it defend those returns for 5 years or 10 years? Um, and that's a more difficult question to answer, right? So the way that we figure out whether a company can defend its returns is we figure out if a company has or can build a competitive advantage, right? So this is a term that gets thrown around a lot these days. I think I read a tweet somewhere that said like being nice is a competitive advantage. a competitive advantage is something that your competitors will either cannot replicate or will have a very difficult time replicating. Or it's something that like a few players in one industry have an advantage and then the rest of the industry doesn't. So then those few players will end up taking more and more share, right? A competitive advantage or a barrier to entry or economic moat, same thing. It's something that your like competitors will have a difficult time or will not be able to replicate, which will allow the business to defend superior return on capital. Like that's what makes a good business, you know, within the definition, like within the kind of capitalistic society that we live in, within the capitalistic game that businesses are playing, right? Like the purpose of a business is to solve problems for its customers and at the same time create value for its owners, right? Its shareholders. And this is how we kind of quantify and think about that. So, okay, so how can a business, like, what are some, the way that we find whether or not a business has a competitive advantage is basically we're going to use pattern recognition, right? So, in the same way that in chess, right, you have Queen's Gambit that's going to show up, that the TV show is going to show up there. So I'm going to use the Sicilian defense, right? So in chess, there's like these clear strategies that all the great chess players know, like the back of their hand, right? Sicilian defense, there's like openings like the Queen's Gambit. And I guess the Sicilian defense is also a chess opening. Same thing in business, right? There's clear strategies that businesses have been using for long time, for many, many years, that have been studied by economists and documented. And so we're going to understand what those patterns are. And then whenever we look at a company, we're going to basically just go through a little checklist and say, okay, does the company have this pattern? Does it have this pattern? Does it have this pattern? Does it have this pattern? No. Okay, this company probably doesn't have any competitive advantage. And not just that, we're going to ask, okay, maybe the company doesn't have it today, but do the structural characteristics exist in this business for the company to eventually build this advantage over time? Okay, so now let's just go through those patterns so that you're familiar with the vocab, and I'll give you some examples, quick examples for each one, right? So the first one and the most common one is economies of scale. Now, this is a term that people in business and finance love to throw around, but I've found that not that many people truly understand what this is. And multiple smart people think about this concept in different ways, right? So, okay, Wall Street mojo. Okay, so economies of scale. Yeah, reduce per unit costs, increase profits, growth of business, business credibility increases. This kind of explains it. The most common example of this is the Amazon flywheel, right? So the idea is in every business, there's fixed costs and there's variable costs, right? So let's say, the case of Amazon, right? The fixed cost is all the warehouses and all the Amazon trucks and the truck drivers they have running around moving stuff from one place to another, right? Moving it from all the ports, whether if they're coming from overseas into the warehouses, from the warehouses to delivering it to people's homes, right? Building out that infrastructure of the movement of goods in the warehouses, that is a fixed cost, right? And the more units that Amazon sells, the fixed cost per unit goes down, right? So the total cost of Amazon goes down as the unit volume increases. So when that fixed cost per unit goes down, that means that Amazon can lower its prices, right? Because on a per unit basis, their costs are getting lower when they're able to spread those fixed costs over a larger unit volume, right? So lower prices means better customer experience, and then because of the better customer experience, they get more traffic. Because they get more traffic, they get more sellers. Because they have more sellers, they get more selection, and then it's like these like conjoined feedback loops that lead to like this nonlinear growth if they can continue to execute on all these things, right? So um, economies of scale, in one sense, you can think about it as, you know, being able to spread fixed costs over a larger unit volume. Another way you can think about, so in this example, Amazon is a good example of thinking about economies of scale in this way. But at the end of the day, economies of scale and like all the other kind of advantages that we're going to talk about, it's all relative, right? So if if Amazon, let me just pull this up before I get into the next part of this. Amazon market share, USA. So see, within e-commerce, right, in the US, Amazon has like 38% share, and the next biggest player, Walmart, has only 6.3% share, right? Um, the thing with economies of scale or any kind of competition is it's all relative, right? It's all relative to the industry that we're talking about. So the reason that Amazon has scale versus Walmart is that it's bigger than Walmart and within e-commerce, right? And they have like more a better like delivery network than Walmart, which means their delivery times are going to be better than Walmart, which means it's going to be more convenient. They have a slicker website, all of these things, right? So Amazon's what really matters isn't just economies of scale; it's relative scale, right? It's relative scale within the industry that you're talking about. Um, like another way to kind of define it. No, I don't want to go into that definition. Let's just stick with this one. It's about relative scale, right? So because Amazon is so much bigger than the next biggest guy, they're able to spread their fixed costs over a larger unit volume than Walmart is, which means that Amazon is able to operate its e-commerce platform um, at a lower per unit basis, right? They're able to get stuff to you faster and at a lower cost because they're so much bigger and they're moving so much more e-commerce, so many more goods over their online e-commerce platform, right? Um, and this isn't including like Amazon Web Services or anything like that. This is just the retail business. So that's one example of economies of scale, right? Just kind of that having like being able to spread your fixed costs over a larger unit volume. Another example of scale is purchasing scale, right? So a, when you're significantly bigger than a competitor, right? So Planet Fitness, for example, right? Planet Fitness spends, I believe, 5 times its next biggest competitor in marketing, right? They outspend them by 5x because they have 5x the locations, roughly, right? So because of that, um, they're able to get better pricing on their equipment, right, from the equipment manufacturers. And so because of that, because Planet Fitness costs are lower, they're able to be profitable at a lower price, right? And then that kind of similar to this, right? It kind of feeds on itself, and you can think of every industry as a race to scale at the beginning of that industry, and then there's a point at which like there might be like multiple runners in the beginning, and then in some industries, as the race goes on, as time goes on, there'll only be like a few people that are like way ahead of the others, and then in other industries there'll be lots of runners still going 10, 20 years into the industry's development, right? E-commerce in the US is one of those industries where Amazon just sprinted way faster than everyone else, and now it's like it's lapped Walmart like several times already, right? Like this is a huge gap in terms of relative market share within e-commerce. Um, so, um, yeah, so that's another example. Purchasing scale, Planet Fitness, they get huge discounts relative to competitors on their equipment because they have way more locations than anyone else in the U.S. Um, Another one you can think about is distribution scale, right? So, when you see people on Shark Tank, right? Um, you know, when they have like a new like mop or like some kind of new product, um, they go to Shark Tank to get distribution deals with retailers, right? Because they don't have the entrepreneurs don't have those relationships, but the sharks do. And it's really not even the sharks; it's the retailers that have that distribution, right? So, like the moment you get your product into Walmart, you get them across all these stores, and your sales can like 1000x overnight, right? Another example of a company that has distribution scale is Philip Morris, right? You know, they sell cigarettes and other nicotine products all over the world, and they're already in so many like retail locations. It's really tough to uh, be able to match that scale, right? It'll take a long time for a business to build out that scale of of distribution points, uh, physical distribution points. Um, Another one is United Rentals, investor relations. I just want to show you a slide from this presentation that'll kind of give you an idea of what to look for, right? When you're looking for a relative scale. United Rentals Investor Day. They just have the webcast. Okay. Featured presentation. Yeah, there we go. Okay. So United Rentals, it's an equipment rental company. So they have a bunch of locations all over the country and all over the United States, and they rent construction and non-construction equipment, right? So okay, so what's interesting and what you want to look for in market share diagrams like this, not every company will disclose them, but when they do, and you see something like this where like there's three companies that have, and other means that no one else in this other section, this 66%, has more than this 4%. So it's like you have these two big guys, a third like semi big guy, and then a bunch of mom and pops, right? So this is a little bit like a game of poker where there's like two bullies that are basically going to crush everyone else in the game that like over time, right? This is what relative scale is about, right? Like when you study this concept of economies of scale, like when I studied this in school, like you can tell, right? Like right when I Googled it, it's like you see all these like charts and like people start, doing calculus, like taking integrals, derivatives. What really matters is like this in the real world, right? Is relative scale. Um, uh, are the average fixed costs per unit for a handful of companies lower than for other companies? Um, are there actual like scale benefits in this industry, right? Um, so this is a really good example of where there are scale benefits, right? So something like super practical and super simple, right? So let's see how many locations they have. They have like 1,500 locations, right? And Sunbelt, their second biggest competitor, which is owned by a company called Ashton Group in the UK, they have, I think, like somewhere between 1,000 and 1,500 locations, right? So when you compare that to most of the industry, which is kind of like single location mom and pop stores, it's easier for these guys to attract talent, right? Because they can offer like, you know, 401k matching, like benefit packages, all these things. Also, they can spend more on technology, right? Like building IT and software systems that makes it easier for the sales guys and the service guys to do their jobs every day. That's a fixed cost, right? It doesn't really matter if you have one branch or 1,500 branches, right? That's going to be a relatively fixed cost of developing that internal software. And you can spread that over more locations, right? When you have 1,500 versus when you have one, right? Um, again, they get a lot of purchasing discounts as well from equipment manufacturers because they can order in more volume, right? Um, another benefit is that they have a lot of stores that are like locations that are close to each other, and they can share equipment from like one store between the stores, right? So that means that the average utilization of all the stores ends up being higher because they just have more availability because customer can make a phone call to like a location in you know um, one town in New Jersey, and then they have another like location that's like 20 miles away, and then another location that's like 15 miles away, and another location that's like 35 miles away, versus like a mom and pop that only has one location, and they have to have more variety of equipment like more depth within each variety available, so that when a customer calls, they don't ever say, "Hey, we don't have that available," right? Like, so because they have all these clusters of locations, um, United and Sunbelt can operate at a higher utilization, right? Don't worry if that concept of like clustering doesn't quite make sense, but the idea is like you get all sorts of benefits in certain industries, not all, in certain industries of being bigger, right? So when you think economies of scale, think like the bigger guy has some kind of advantage, okay? Now, when I say bigger guy, I don't necessarily mean bigger in an absolute sense, right? I mean bigger in that specific market space or that specific geography that the business operates in, right? So, for example, like a coffee shop in New York doesn't compete with a coffee shop in LA, right? Like a coffee shop is a local service business, right? Same thing as like a restaurant, right? So, um, in that case, the competition is really like whatever is in that local market, like in that geography, right? Within like a whatever 1 or 5 mile radius, depending on if you're like in a city or a suburb, right? So when you think about local competition, you can think about a company like Charter, right? They Charter Communications. Uh, yeah, so they own Spectrum, right? Like they have like whoever your internet service provider is. There's regulations around these companies, but let's just ignore that for a second. The way that internet is delivered to you is, a company, many years ago, went into that town that you live in, and dug out a bunch of, you know, dug a bunch of dirt and laid out all these cables and wires to connect to all these towers. Um, and and that's basically how you get internet service, right? You might think it's like wireless technology, but it's actually just a bunch of wires like running through the ground and above the ground, right? So wiring up a town is a pretty high amount of fixed costs, right? And so generally these businesses that did that, and it's the same thing with electric utilities, right? Um, they're very local businesses, and it's very difficult to displace one of them once they've kind of paid that upfront fixed cost of you know wiring up like a zip code, and so they end up having like a lot of market share versus a company that's in kind of a perfectly competitive industry, right? Um, so because that cost is upfront and fixed, every dollar that they get from like new sales kind of just drops straight to the bottom line. And you know, usually, if you do the math, it takes a lot of new customers. So I'll give you an example, right, just to kind of make this concrete. Let's say there's a town where there's like 100 households, okay? And let's say just to break even on the fixed costs of like managing like all the because like it needs like repair and you need like technicians, so there's ongoing fixed costs every year of just maintaining internet service to those 100 households, right? So let's say you need like 50 households just to break even. I'm just making up numbers. Let's say you need 50 households just to break even on those recurring fixed costs, right? So you need a 50% market share just to break even on the fixed costs of just running the business, right? So that makes it very difficult for a new entrant to come in because they need half the market, just to break even every year, right? So that gives a huge advantage to the incumbent that's already there, that's already like fully, wired up and has acquired, let's say like all the customers in town, right? So in those kinds of business, in those kinds of situations, you can look for local economies of scale, right? In terms of geography, like the example I just gave you, or another example would be in terms of market space, right? So an example of this would be like a niche manufacturing business like TransDigm. Um, so TransDigm, they're an aftermarket parts provider for aircrafts, right? So for defense and for commercial use, like airlines. Let me see if I can find their investor presentations. Here we go, presentations. So the way this business works is at the beginning, when an aircraft is being, spec'd out by, Boeing or Airbus or Lockheed Martin or, Raytheon or whatever, um, they have a bunch of original parts manufacturers that get approved to be like manufacturers for the aircraft, that specific aircraft, whether it's like the 737 or, you know, uh, Airbus XYZ or whatever, right? Um, but aircrafts last for a very long period of time, right? And then eventually they go from, oh man, I'm doing a terrible job of explaining this. It doesn't really matter that you know the exact mechanics of this, but just look at this slide, right? Proprietary revenue is 90%. So in 90% of the like of their revenue base is markets where they're the sole provider of that specific regular regulatory approved part. So like a valve that goes into like or like a lock that's like on or like a little part of like a seat in an airplane or a little really specific part or a cushion or like something, right? And there's like significant regulatory complexity in terms of like who's allowed to sell those parts for like insurance purposes because you don't want like to switch parts providers and then cause some kind of malfunction in the plane. And it ends up being like a very small percentage of the costs for the airline, for the aircraft owner, and so they don't really care about overpaying for these little tiny little parts, right? Um, and because they're so niche, there's only like one or three manufacturers in many of these little parts, that go into the plane when it's originally spec'd out. And so you fast forward like 20 years when that specific plane isn't being manufactured anymore, and now it's in that aftermarket phase, right? You end up getting these markets where there's these niche markets where one or two manufacturers like own the entire niche market for like a specific part. So what does TransDigm do? They go and acquire these niche manufacturers, right? And it's kind of like one of the great uh, you know business models of all time, right? I'm not saying it's necessarily a good investment because you have to take price into account and what the future growth prospects look like and kind of estimate what the future returns are. But you can look at the stock, right? Like it went from $25 in 2006 to like $900 today, right? And if you go back to the 90s, it's like an even more amazing return. Like if you want to hear more about TransDigm, there's a podcast. Let's see, TransDigm. Yeah, you can listen to these couple episodes on and oh no, this isn't the best like the best. Okay, so yeah, it's called Foundations with Nick Howley. So he kind of explains this is a founder of the CEO of TransDigm. He talks about how he built the business and all these things. If you're curious to go deeper on this one business, like a lot of like very sophisticated investors, I think still own uh, TransDigm because of this, right? So okay, so that's all economies of scale. We're already like 43 minutes in. Um, this is yeah, like I said, like this is a big topic. I'm probably not doing the best job explaining it. I'm just getting you introduced to this topic so that you can kind of do more reading and research on your own um, and kind of wrap your head around these ideas of um, building competitive advantage. Okay, economies of scale. That's the first one. Next one is demand side advantages. So the most kind of simple example of that is, any kind of company where, so economies of scale is kind of a cost side advantage, right? Because it's like a niche market or because the business is able to spread like fixed costs over a greater base of units that they sell. They operate at a lower cost, and they're able to get more market share because of that, because they can charge a lower price. Demand side advantages are it's like reasons why customers are less likely to switch from one company's product to another, right? So a classic example of this would be like Philip Morris or Altria or British American Tobacco, right? Like cigarette users are very loyal to their brand, right? similar with vaping or nicotine pouches or heat not burn tobacco, because people get used to um, that flavor and that sensation that they get from their specific brand. There's also like kind of psychological aspects to it where people associate with the Marlboro Cowboy. It's they have a brand basically, right? And so and also out of habit, they don't really want to switch, and it's like a low percentage of their income, and so just they'd rather just stick with their own brand instead of trying something new, right? Like Coca-Cola would be another kind of potential example of this, although it's not Coca-Cola's advantage is not as strong as I would say as Philip Morris, right? The other thing I forgot to mention about finding these patterns that businesses these strategies the business can use to defend um, their return on capital, and your investor has an ability to find these businesses that can sustainably earn high rates of return over long periods of time, right? The other aspect of this is that there's a spectrum, right? It's not just that a company has an advantage or not. It's not binary. It's not one or zero. Let's call it a spectrum from on a scale of 1 to 10, right? So on a scale of 1 to 10, maybe you can say again, this is where it gets subjective, right? Maybe you could say that Philip Morris's demand side advantage with their customers is like a 9 out of 10, and Coca-Cola is like a 7 out of 10 or something, or a 6 out of 10, right? And you back that up by looking at market share changes over time. You would you can look at like survey data. You can look at uh, yeah, like you could look at all sorts of different data that like the two I just mentioned to kind of validate that hypothesis that there are demand side advantages, that people don't switch, that they're brand loyal, right? Um, the other one is within demand side advantages is switching costs. So one example of this would be Salesforce. Again, I'm not recommending any of these stocks. Like I just want to be like really clear about that. I'm just using them as examples to demonstrate these concepts. Okay, so Salesforce sells software to companies, right? If you worked at like a big company, how like bureaucratic they can be, and like that there's systems, processes, and workflows in place that are very difficult to change. And it's like if you change one thing in a company about how like one aspect of it's done, it like ripples out into other parts of the organization, right? Like you don't want that, right? Um, and so when Salesforce sells software to other companies, right, cloud-based software, um, these other companies, that software becomes integrated into those companies' workflows, right? Into how their employees interact with each other, how they interact with suppliers, how they interact with customers, most importantly with customers. And they don't really to switch that would require retraining and like all it's like a huge mess, right? So this is referred to as switching costs, right? Switching costs. Um, yeah, so this is a term that you can look up and kind of get a little bit more depth. Wall Street Prep, I think, is a pretty good website for this. So those are kind of demands. Another one would be like Workday, right? If you've ever worked at a company that uses Workday, you know that like a lot of like performance reviews are done on Workday, right? That a lot of the human resources department of a company, if you ever watch The Office, it's like what Toby did. Um, Workday powers a lot of that, right? And so it's difficult for a large company with like thousands, hundreds of thousands, maybe even 1 million employees, to switch from like one HR platform to another, right? Because there's all sorts of costs and like friction associated with that, right? So that's an advantage for a lot of enterprise software companies, particularly companies that sell to the government also, right? Where you sell a piece of software, it becomes part of that company's like you know day to day workflows, like work streams for its employees, and then it becomes very difficult to displace that, right? So that's an advantage that company has. It's very difficult to steal that customer that is already kind of like integrated into that software company system, right? So I hope like this aspect of this concept of competitive advantage is kind of starting to sink in, right? Like it's that um, what qualitative factors and also some quantitative factors allow a business to defend and continue to earn high rates of uh, returns on its capital, right? I'm not talking about stock returns. I'm talking about the business's return on capital. Okay. Um, the last the third category of advantages, we'll call them supply side advantages. Okay, so the best example I can think of this is Saudi Aramco. So Saudi Aramco is the company in Saudi Arabia that has all the like oil fields in Saudi Arabia. They're very productive, right? So like what you have to understand about oil fields is that it really matters like where you a bunch of companies go around poking holes in the ground and oil comes up, right? If you poke a hole in the in the middle of New York City, you're not really going to get oil, right? If you poke a hole in the middle of nowhere, maybe you'll get oil, right? But that cost of poking the hole and sending all the machinery down, that's fixed, and then how much oil comes up, it's all like incremental, right? So what really matters in this business of discovering and drilling and exploring oil and gas is where you decide to dig, right? So there's some parts of the planet where there's a lot of natural resources, and there's other parts where there's not so many natural resources, right? The cost to go down is the same, but the amount of oil that comes up is different, which means the cost of extraction is way lower in Saudi Arabia and the Permian Basin of the United States versus like offshore, right? Or I don't know, in like the Dakotas or something, right? Um, so Saudi Aramco, it has a supply side advantage because it has access to this critical resource, right, of oil reserves, right, and that's entirely supply based. It's literally they just have this kind of privileged access to this natural resource that happens to be beneath the ground, where they decided to dig, 100 years ago, right? Another example of this would be patents, right? Like when you think about competitive advantage, at least when I first was introduced to this idea, that was like the easiest way for me to wrap my head around it, right? It was okay, like the government says you literally have the exclusive right to produce this product for whatever, like 20 years, right? So like companies like Pfizer or like these drug companies or whenever you watch Shark Tank or a lot of the times it's like a little gizmo that's being sold, the sharks always ask like, does this have a utility patent, right? Or whatever types of patents out there, right? Like I'm not an expert on patents, right? So that's another example of a supply side advantage where you have the right to sell, as dictated by the government, a particular product, and no one else can replicate you for a number of years, right? Another example of this would be railroads, right? CSX, Canadian Pacific Railway, right? There's not too many new railroad tracks, being laid down, right? And a key aspect of this is like, different tracks like connecting to other tracks and having this wide kind of network of being of routes where you can send stuff from one part of the country to another part of the country, right? You can't know like people aren't laying down new railroad tracks to take goods from the East Coast to the West Coast or even from the East Coast to the Midwest, right? So because there's like towns and there's like zoning and it's all this complexity, right? So similar thing with airports, right? So because they have this legacy infrastructure that's not going to be replicated anytime soon, that's a competitive advantage, right? That's a supply side advantage. They have access to this critical resource of railroad tracks, right? The last type of competitive advantage is kind of the sexiest one that a lot of tech investors really like to see. It's very powerful, but it's a double-edged sword, right? Like when it works really well, but when it cracks, it can like crack very fast. So they're called network effects. Network effects. There's like a ton of literature on this. This VC firm NFX, they have a lot of really good content on doing on network effects. What are they? Different types of network effects. If you really want to go down this rabbit hole. The idea with network effects is that they exist when one customer, like when one customer starts using that product becomes more valuable for all customers, right? So a great example of this would be Visa and MasterCard, right? So on one end of the network, you have the merchants, right? The businesses that accept Visa and MasterCard. And on the other side, you have customers, right? That have the cards to swipe. So you have this like two-sided platform where it's like a chicken and an egg problem when you first start out. But then once you solve that, you have this network where it's very difficult to replicate because customers want to use the credit card company, the credit card network that has the most number of merchants, and merchants want to use the want to accept the credit card that has the most number of customers. Right now, um, this is one type of network effect because companies can have multiple um, credit card processing companies that they use, right? They can accept Visa, they can accept Mastercard, they can accept Discover, Amex, right? Whatever. Um, Another example of this would be obviously like social networks, right? Like Facebook or TikTok, right? Like you go on Facebook instead of MySpace because more of your friends are on Facebook, right? Versus MySpace. Um, if you fast forward to when Facebook was founded, MySpace was ahead, but because Facebook had a better user interface and they nailed the product in terms of what people actually wanted, they grew very fast and they dwarfed MySpace very quickly, right? And once they had that advantage of it was very difficult to replicate that because um, people want to use the social network that the most amount of their friends are on, right? Now, I haven't really discussed this idea of like disruption, but competitive advantages are built over time and they eventually erode, right? Like I said, all businesses are have finite lives, right? No business lasts forever. So these advantages that I'm talking about, they can exist and they can be durable, but they're not going to last forever, right? So it's always a question of like, okay, is this company, is this advantage going to last for 5 years, 10 years, 20 years, 50 years, right? And that's a very subjective thing. Smart people can disagree on that, right? So this is when kind of your judgment comes into play, and this is why it's good to diversify your portfolio and have more than one uh, stock, right? Because if you look at the example of Facebook, right now there's not just Facebook. Now there's Snapchat, there's TikTok, there's Instagram. They were able to buy Instagram, but imagine if they weren't able to, right? What's happening in social networks is it's almost become like split up by generation, right? Like it's almost like baby boomers are on Facebook, millennials are on Instagram, and the next generation. I always get like Gen X and Gen Z confused. The next generation is on TikTok or Snapchat, right? So the network effects in Facebook weren't as powerful as people thought, right? Like another good example of like network effects that people thought were really powerful in the beginning was Venmo, right? And now you have other, now you have Stripe that's coming in, right? The idea with Venmo being like you want to be on Venmo versus like some new startup that copycatted Venmo because more of your friends are already on Venmo, right? And so if you're already a Venmo customer, like your Venmo becomes more valuable to you as more users get added on, right? You can see how that becomes like a really powerful feedback loop, right? Which is why, and also network effects. It's initially a chicken and an egg problem. Usually like you have to solve like either for the egg or the chicken in terms of in the Mastercard example or in the example of Venmo where you have to spend money to acquire that initial whatever 1 million users. But once you get it going and once you're further along than your other competitors, it becomes a really powerful feedback loop that is not very capital intensive to maintain, but can generate, so therefore can generate very high returns, right? Airbnb is a great example of network effects, right? That's why they're able to generate, that's why the business literally has negative invested capital, right? Because hosts want to be on the platform with the most users, and users want to use the platform with the most number of hosts, right? Um, Another example of this is like auctions, right? So um, eBay is a really good one to discuss, and we're already over the 1 hour mark. Nice. But I hope you guys are getting good value out of this. eBay is a good example of this because it's an auction, right? Like people want to sell into the auction markets where there's the most liquidity, right? Like sellers want to go to the auction where there's the most buyers, and buyers want to go to the auctions where there's the most sellers, right? So auction markets, once they develop, again, it's a chicken and egg problem initially, but once you solve it, they can become really good businesses. Auctions, two-sided marketplaces, or auctions end up becoming um, really good businesses because of this pattern of network effects, right? The way that network effects can get broken though is if the demand for whatever product is being sold starts to diminish, right? So in the example of eBay, I mean, obviously the stock has done very well, but if you look at the business metrics, right, it's kind of the growth has like been has slowed down. It doesn't grow as fast as it used to, right? Because you have new entrants like Amazon, right, where they were able to offer a better product to the end customer, and then all the sellers switched from. I don't want to say that they necessarily switched from eBay to Amazon, but it's a more attractive product. Like Amazon just grew faster than eBay, right? Like it was just a slicker user experience here. You don't have to like bid on all these auctions, because Amazon had economies of scale. They were able to sell, whatever you were going to buy, at auction on eBay at like a lower price and at larger quantities. And so I mean, eBay still exists, but a lot of the growth, the future growth, I would argue, was probably taken away by Amazon, right? Because a lot of eBay's business is also the buy it now button, right? Where there's a lot of professional sellers selling online, but it was just Amazon just had a slicker website, better user experience, better like logistics network to actually, get you the product sooner instead of decentralizing that and leaving that up to the customers, which they ultimately use like FedEx or UPS. But now Amazon has better kind of delivery capabilities, and because they got so big, they were able to invest all this capital and really and have a very good customer experience. I don't want to say they disrupted eBay, but I would bet that if Amazon didn't exist today, eBay would be a bigger business, right? So that was me rambling for an hour about kind of just introducing you to the idea of competitive advantages, right? So just to like list them out one more time, they are economies of scale, and I'll have this in the notes. So economies of scale, demand side advantages, supply side advantages, and network effects. So if you really want to go deeper into, there's like a lot more that I could say about this, but I could talk about this for like you could have like entire college courses dedicated to this concept. And I mean, people dedicate their entire careers to like learning how to identify and evaluate competitive advantages, right? So this is just an introduction. Like the main goal that I want you to have is to really think deeply about whether a company can compete, right? Like think about it like this, right? Whenever you're looking at a company, right? Think about it like almost as if it's a sport, right? You're looking at, let's say you're looking at like Salesforce, right? So you find like specifically what problem that company is solving and what like industry that it operates in, right? So for Salesforce, they sell software that helps companies manage their relationships with customers, right? So then you go look for other companies that are doing the same thing, trying to solve that same problem. And then you treat that game, because it is a game. Every industry is a game or a war. There's winners, there's losers, right? There's disruptors, there's incumbents. Within that game, I would try to think about like, okay, is there a Michael Jordan in this industry? Is there a LeBron James caliber organization in this industry, or is it a bunch of like average players, or is there a bunch of is there like three companies or five companies that are like like you look at like Uber and Lyft, right? Like that would be like two companies that are like Hall of Fame caliber that are like really like going head to head competing, right? Uh, versus something like Salesforce, in that specific industry that they play in, they're by far the leader, right? Um, and so when you have one company that's like the leader and um, in terms of like the value they deliver for the price that they charge to their customers, and there's no one else that's come anywhere close, and there's a lot like they haven't fully penetrated the addressable market that they can penetrate in 10 years, that means you have a company that has a defensible advantage, right? Or it might have a defensible advantage because there's a clear leader and there's runway for growth, right? Which means they're going to continue to get bigger and bigger, right? So those are kind of the things that you want to look for, right? You want to look for the company in that industry that is offering the best value for the lowest price, right? In airlines, you can say that like Southwest is a great example of that, right? In the routes that they serve, right? So that's the other aspect of this is like Southwest doesn't compete with United 100%. There's some overlap, but it's not 100% overlap, right? There's some routes where United is on that route and Southwest isn't, right? Like Southwest isn't flying people from like New York to like Hong Kong, right? As far as I'm aware, right? They're primarily a domestic airline, right? So, and there's routes where Southwest is competing and United isn't competing. And then there's some routes where they do compete, right? So you have to kind of look at like actual overlap because not every company that's in the same industry is actually competing for the same customer at the same moment in time, right? Um, and these are things that'll be discussed in the annual report, and that's what you go back to that one of those initial videos where I gave like the list of resources. That's why you read stuff like on Value Investors Club, um, or Seeking Alpha, um, Seeking Alga, Alpha, or Substack. Um, Right. And now that you've seen this video and you kind of have this idea of what does it look like for a company to have competitive advantages, you know, um, when you do read other people's write-ups, you can look for these things, right? If people don't discuss these things, okay, so that's what's missing from this write-up. It doesn't mean it's bad, but that's kind of where your work can begin. Or you can just say, okay, they didn't really discuss, you know, they didn't do a good job of explaining this. I'm just going to pass, right? Um, so yeah, I'm just trying to think if I want to say anything else in this intro video. But yeah, I mean, as always, post your questions, comments below, and I'll get back as soon as I can. I'll see you in the next video.